We're looking at a piece analyzing Applied Digital Corp's strong fundamentals despite a recent stock dip. And we're jumping right into 2 ways to make its bullish case even more powerful.
Sounds good.
So the first opportunity is really about maximizing the narrative link between the company's new debt and its future revenue.
Right.
The analysis does a good job highlighting the 2 big numbers, the $2.35 billion debt offering and that huge $11 billion CoreWeave backlog.
But the structure feels a bit off. The weakness right now is that the debt, the very thing that caused the stock to dip, is framed as just a fix for liquidity issues.
Exactly. And the massive revenue it secures, which is the whole point, it sort of feels like an afterthought.
You're letting the reader start with the negative, with the liability.
We need to flip that script. The suggestion here is to immediately frame that $2.35 billion liability as the required investment for the asset.
The key that unlocks the whole thing.
Yes, the 400-megawatt Polaris Forge campus. That's the asset. The $11 billion lease depends entirely on it.
So for a concrete example, instead of talking about the debt and then the deal, you lead with it. You say this $2.35 billion offering directly secures revenue that is almost double the company's current market cap.
That ratio is everything.
It is. It just lands differently. It immediately changes the conversation from, oh, they took on debt, to, wow, what a strategic move.
Perfect. That reframes the technical dip as just the cost of entry for securing massive long-term value. Okay, let's move to the second point.
Let's do it.
This one is about strengthening the competitive moat to justify those very aggressive financial goals.
The North Dakota power advantage.
Right. The piece identifies that moat, the gigawatt-scale power they have access to, but it needs to connect it more explicitly to their big financial targets.
I see that. It connects the moat to the Q1 revenue, which is great, but then it just sort of mentions management's goal of $1 billion net operating income run rate.
And that jump can feel a little abrupt.
It does. It almost leaves you wondering, couldn't that goal fall apart if their operating margins aren't actually better than competitors, cheap power or not?
That's a fair question for a reader to have. That billion-dollar NOI, their pure operating profit, it needs to feel like an inevitable result of the moat, not just a hopeful target.
The how is missing.
The how is a bit implicit, yes.
So the suggestion is to bolster the case for that billion-dollar goal by explaining precisely how that geography creates a quantifiable economic advantage over peers like Iris Energy, or even CoreWeave itself.
You have to move beyond just saying it's a good location.
Exactly. You need to show the economic math. For example, include some specific details. How does the North Dakota infrastructure translate into better margins?
Maybe they have significantly lower power purchasing agreement costs.
Right. Is it 10% cheaper? 20%? Or maybe it allows for faster deployment speeds than in other, more congested markets.
Show that tangible advantage.
Precisely. That's the kind of detail that shows why analysts have a strong buy on the stock with a $42 price target. It makes the moat feel real and impenetrable, not just a talking point.
Excellent. So to recap the 2 core suggestions for improvement. First, structurally link that $2.35 billion debt offering directly to the massive CoreWeave revenue it secures. Flip the narrative from liability to strategic asset from the very first sentence.
Make it a power move.
And second, explicitly demonstrate how the North Dakota competitive moat fuels that ambitious $1 billion NOI run rate. Show the math with quantifiable economic advantages.
Connect the dots for the reader.
Exactly. These changes will really amplify what is already a very